Drop it.
Hello and welcome to Be Real, the Maryland real estate podcast. I'm Brad Cox with the Vesta Group of Long and Foster, and I'm joined by the ever convivial.
Convivial. Well, ever and convivial are two different letters, so that at least you lose
But there are
points for
V's.
alliteration.
There are V's.
Okay.
Ever and convivial.
All right, convivial.
Yeah. 3 V's.
Michael Becker. That's my name. And I work for Sierra Pacific Mortgage.
Michael, great to see you.
Great to be here today, Brad.
Yeah, so I'm hoping we survive the cast without any major storm.
These are first
noises coming
thunderstorms of the season, I think.
Maybe they are, yeah.
First time that there was actually, like I got up this morning, there was some humidity. It wasn't warm.
No, but it was.
Temperature-wise, but it was steamy.
Yeah, you could feel it. Yeah.
Very steamy.
Yeah, the harbinger of things to come. Yeah, but
I'm not a fan
so,
of steamy. The whole longer, well, it'd probably cool off.
Right. Well, it was beautiful. Those days when it got up into the 80s with the low humidity,
Oh,
I
at night.
love that.
Wouldn't that be nice if you could have
Yeah.
low 80 highs and 57 at night and it was
Yeah.
cool and
Right.
not humid?
Yeah, that'd be beautiful. Can we do that
Have to
during
move
the
to
summer?
California
That
or
would be.
somewhere, I think.
Yeah, maybe that's true.
But they have their own problems.
Yes, they do. Yes, they do. So, hey, an interesting little tidbit. I was looking at our podcast metrics. We have 5 people listening from Seattle. Seattle.
I love that.
Hey, so shout out to Seattle. We got 5 Seattleites. I don't know what you call people from Seattle. I like Seattleites though because it's
Seattleans?
I like Seattleites because satellite Seattle.
Yeah. That would confuse me.
Yeah, well, but anyway,
That is cool.
It's
Keep
very
listening.
cool.
Tell
Yeah.
your buddies to listen.
Yeah. So anyway, welcome Seattle and anyone else who's listening from anywhere else. All right, so Michael,
Yes, sir.
this episode, we got a pretty good episode in store. We've got some really great content on talking about some of the advice that we've been giving people for quite a while, past couple of episodes.
Well,
We've
we've
been talking
mentioned
about
it,
the
so
idea.
it bears
Yeah.
going into a little deeper detail.
Yeah.
The biggest struggle so many first-time home buyers, or home buyers that matter, but I want to focus in on first-time home buyers.
Yeah.
They want the turnkey ready, the HGTV, however you want to describe the house that's ready to go. With everything's been updated within the last few years or 5 years, so not much has to be done to the home. The issue is there's still limited supply.
And
Demand
if
is
they love
exceeding
it,
the supply on those type of homes.
Right.
So there are competitive situations on almost every.
I always tell clients, if you love it, that means everybody else is going to love it too.
That's a great point. Great way to look at it.
Just, keep that in mind. Yeah.
So the issue is that it's harder to get. If you're somebody who doesn't have deep pockets, meaning you're not willing to go over at list price.
You don't have the equity from a previous home. You're, to your point, a first-time home buyer. You don't have that equity, so you can't roll that into the next purchase. You can't compete as much.
You can't do a gap
right?
coverage.
Can't cover
like
the gap.
You'll go over the list price and you'll cover, if the appraisal doesn't come in, you'll cover up to 5 or 10 or 20,000, whatever the number is.
Right.
You may not have that money, so you're consistently getting beat out by others with those type of offers. We suggest to people maybe temper your expectations and look for that diamond in the rough.
Right. So that's what we're going to be talking about today. Buying that diamond in the rough. Home buying with renovation loans. I'm looking forward to that. That should be a really good episode. By the way, speaking of
Yes, sir.
first-time home buyers, I'm leaving the phone on, not on Do Not Disturb this time, because I'm waiting for results on an offer. I'm hoping. I got my fingers crossed.
Was it competitive?
Yeah, highly. But we put together a really nice, compelling offer, and I believe we have a shot at it. So we're praying. We're doing how you do the rain dance. You do the offer
It's
dance.
very strange these days how the market is like that. I was talking to Mindy earlier today, and I said, we're a year into high rates. It's no longer a new thing that rates are high.
Right.
This time, they're much higher than they were this time last year, but by this time last year, they'd already started rising and rising pretty quickly.
Yeah.
We had a big spike into the summer months of June and July, and then there was a nice rally into August, and then the sell-off continued and they worsened. So it's been a while, and it doesn't seem, she was surprised, it doesn't seem that those higher rates have
deterred people.
Deterred or dulled the desire to buy a home or be a homeowner.
I think it's tempered it a bit, but
it's priced some people out.
Yeah.
It's economically changed things, but those, and that might be what we're going to kind of talk a little bit about there. Here's another foreshadowing for the Unreal.
Right.
We'll talk a little bit about that on the Unreal.
Yeah.
It has priced some people out of the market.
Yeah.
Which we've said time and time again, if you have the ability to buy a home in this market, it probably makes more sense to move forward now than to wait for rates to come down, because what do you think the competition will be then?
Right.
It's going to be insane.
Yeah, absolutely.
Hopefully we'll have some more inventory, so if there is more demand.
Right. Hopefully.
All of us in this business want it to kind of balanced market is when everybody's happy.
Right.
And you're going to talk about that. But first, what am I going to talk about? Mortgage application activity and mortgage rates.
Yeah.
So I always go off the Mortgage Bankers Association every Wednesday. This is from the previous Wednesday, and that was the date of Wednesday was the 12th, but it was for the week ended April 7th. Mortgage applications increased, drum roll, 8%. Ooh, big increase.
That is
huge
increase.
Big
number. Yeah.
And it was all because of purchases, because the refinance index was only up 0.1%.
It's not surprising. But
it goes to show you how much activity increases when rates rally. We had a little rally because there was data coming out that week showing that maybe the job market was softening a little bit, because we've seen a little bit of improvement on the inflation data.
Yeah.
And we've also seen it seems like the economy is getting a little slower, but jobs seem to be resilient. The employment report constantly is showing it looks. In fact, the last one was good. But that came out before these rates came out, so that's probably why we saw it. So anytime there's a little dip in mortgage rates,
people jump off the couch
and move. The average that week, according to Mortgage Bankers Association, was 6.3%, paying about 0.6 points.
Yeah.
I think I always like quoting 0 points or very close to 0 points. We're probably closer to 6.5 right now. As of today, and the last week we saw a little sell-off. It was interesting because the Consumer Price Index showed headline inflation coming down pretty good to 5%, but the core inflation was right at or slightly above where they were expecting at 5.6. That's a concern. The Fed's looking at core inflation and services inflation, and that hasn't come down as fast as they would like. Interestingly enough, the next day we had Producer Price Index, which should flow into Consumer Price Index, and that was extraordinarily weak. In fact, they actually showed deflation or prices dropping on the headline number and flat for the core number for that. We had retail sales on Friday, which were weaker than expected. You would have thought that bonds rallied, but interestingly enough, there was a University of Michigan has a consumer sentiment survey, and that came out a little stronger. Not than it was expected to come out stronger. It was slightly stronger than expected, but it was the year-over-year inflation expectations that caused bonds to sell off. Consumers are now expecting inflation for the next year to tick up to 4.6%, and that's high. Last report or last survey, it was 3.9%.
Yeah.
So if people think inflation is going up, it does. Inflation tends to happen because they act on it.
Yeah.
They buy things now rather than wait,
and that causes inflation to go
exactly. If there's stronger demand than supply for any item, it tends to drive the price.
We need another pandemic to lock people in there.
No, we just need the Fed to be steadfast. And it's interesting that most Fed officials are talking about it, but we are seeing some dissension. There's a few doves out there. The latest one, Austin Goolsbee, who used to work for President Obama, is now he's going to be the head of the Chicago Fed, and he is a voting member. And he is stressing for patience in rate hikes, where others, like John Williams, the head of the New York Fed, says, and Waller, I think he's of the Dallas Fed, are saying, market is not pricing in higher for longer rates, and we're here to tell you they are going to be higher for longer.
Right.
Well, I think they're just talking tough, because the bottom line is what they do say they are is they're data dependent. So as data comes in, we're going to see changes in mortgage rates. It's one of the good reasons. It's nice to have someone like me who watches all this data, know what's going on.
Yeah.
I had somebody who was interested, in a mortgage. He was under contract, and I sent him numbers. And I know I was in a competitive situation. I probably shouldn't do this, but I had a feeling he would, because he had a leg of demand to go with me, and it looked like bonds were selling off. I locked him in on Thursday, and he called me. I said, "Hey, I understand pricing is a little worse today. Can you send me updated numbers?" I said, Now, I locked you in
Congratulations.
yesterday. He was super happy.
Yeah,
So,
I bet. What do you think? I mean, what I've been hearing is that the potential for rates to come down more significantly is probably pushed back to toward the end of the year.
Toward the end of the year or early 2024. So this is here's something, and I'm stealing this from my Twitter buddy, and a guy who works for Housing Wire. If you ever listen to this podcast, so I'm giving you your props. Logan Motoshami. He's also on CNBC. He used to be one of the voters on bankrate.com with me, the mortgage rate index. He says Fed is focused on employment, and you'll probably need to see jobless claims, not the employment report, go to about 340,000 before you really see bonds start and rally. Now they have ticked up. Last week it was 239 or 240,000, which is higher than the high. It was below 200,000 for a long time. Yeah. So that has ticked up a lot, but we still need another 100,000. So pay attention to that number. If every Thursday morning jobless claims come out, isn't that terrible? We want to see more people claim.
You don't want to, but
if you want lower rates, unfortunately, the job market's got to cool off a little bit, and that'll help cool off inflation. Although I say it time and time again in the Maryland area, unemployment can go up across the nation, and we seem to be resilient because of the proximity of the federal government.
But we could benefit from other areas.
Mm-hmm. Yeah. Well, there's a lot. It's not only the federal government, but so many businesses that do business with the federal government are located in Maryland or around Maryland and Virginia.
Yep. Great. All right. Well, Michael, great information. Thank you. We're going to roll into the monthly data this time. We've got monthly data for all of March now. So I want to talk about the Baltimore Metro data provided by Bright MLS. By the way, I keep meaning to mention that's where I'm getting my data from.
We didn't think you were pulling it out of
I don't make it up. I don't make it up. But Bright MLS it's the main repository for all the data, and so data coming from Bright MLS. Typical seasonal increase in housing market activity in March. Higher closed sales, more showing activity, little decline in the median days on the market. But in general, overall, market activity is a little slower than a year ago. So let's go into the specifics. Closed sales 2023, March of 2023 versus March of 2022, down 24.8%. Not surprising. Just volume is just down. The median sales price, this was interesting for Baltimore Metro. For the first time since 2018, median sales price year over year for the month of March dropped 1.5%. Now, again, 1 month doesn't make a trend, but it's something to watch. All right. Median days on the market ticked up to 10 days. It was around 6 days in March of 2022. The new pending sales down 27.9% from March 2022. New listings down 35% from March of 2022. Active listings, though, are up, so the overall total number of listings are up.
That's interesting.
Yeah.
As fast as houses are going these days.
Yeah. We've had some sit a little bit longer. Again,
is that what it is?
Yeah, there's some. But month of supply actually went up pretty significantly, but from the basement. So it went up from less than about a half a month to 1.13 months year over year. Okay. So you remember back in March of 2022, we reached the absolute depths of days on the market. So
well, it makes sense.
The months of supply.
Well, especially because rates started rising right as 2023 rolled in. They were very close to their all-time lows in November and December 2022. It wasn't until almost 23 that markets realized the Fed's going to get serious about inflation. They were behind. They were way behind, acknowledging that it was an issue.
Yeah.
So people, I think, back then were rushing if they were thinking about buying a home to go buy a home before rates went up.
Yeah. Good point. Showing volume down year over year, March of 2022 to March of 2023, 30.6%. Now, I'll throw I think a very reasonable theory out there. I just don't have the data for it yet, but I think a lot of the showing activity decline isn't so much. You could chalk a lot of it up, some of it up to rises in interest rates. But I think part of the other aspect of the total volume of showing activity going down is the fact that people have to move faster. They have to act quicker because there's such little inventory. They're seeing fewer homes. So they're writing an offer after seeing fewer homes.
It seems the norm. A well-priced and nice home.
Yeah, goes very quickly.
Listed Thursday, offers in by Sunday.
Yeah, if that.
If that.
Yeah, the one that I'm waiting on was one day, and they wanted the offers by the next day.
Wow.
Yeah.
Did you get in to see it?
Yes.
You were one of the lucky
few.
few.
I saw it coming, so I booked the showing 4 or 5 days out, knowing that it was going to go active on the weekend. So I booked for the weekend, showed the house, and then had the offer pretty much pre-written before it's kind of funny. The client and I were talking back and forth. I had pre-written the offer.
Hey, you're ready to go.
But when we started talking about what's going to take, what do we want to offer, or whatever, I had to change one number in the offer from what I had written originally.
You knew your
so it was pretty cool.
Well, that's good to hear.
Yeah, it was funny. But anyway, all right. So the overall trend is volumes down from last year. Now, that's not a surprise because we had tremendous activity in 21 and 22. So, it's not a surprise that we're down.
With the higher rates, it only makes sense that activity's down a little bit. Like we said earlier, some people unfortunately may have been because the higher rates are priced out of the market.
Yep. And supply is going to continue to be a major constraint in this area. We're struggling with it. It's going to be a problem for a while. So that aspect, the interest rates movement, the economic uncertainty, some of those things are going to influence how much people participate in the market.
So this goes to an interesting question I had from a client, a first-time home buyers I talked to this morning. I had a little consultation with. He said his biggest concern, and it might be, and you and I have refuted it time and time again, and it might be from social media. There's so many experts on social media predicting the housing crash. Right? And he said, what if my biggest concern is buying and prices going down. I said, I hear you. There's a lot of voices out there saying that, and it's mostly because of how much values have gone up. But the demographics and the imbalance between supply and demand don't say that. And especially in this area, we've seen big price increases, but nothing like some of the hotter areas. And those are the areas, and it's been proven true. We talked about it in previous podcasts, that have seen a little bit of pullback in prices.
Yep,
we haven't yet. Although you did say the median price was down a little bit this month. That's a 1 month. That's not a trend.
1 month, right? Not a trend. Yeah. So anyway, but yeah, good point. All right. So we're going to watch and we're going to see what happens with that median sales price. Like I said, the coming months are going to tell a lot about what happens there. I wanted to give some more detail on the days on the market because I said it ticked up from 6 to 10. And was that a sign of, a slowing market? Well, 2021 and 2022, they were on average in March, they were 6 days on the market.
Okay.
So that's just blazingly fast. 10 now. In 2020 in March, that was now, that was the beginning of the pandemic.
That was a nightmare. I can remember people under contract and the things you had to do to make sure that loan closed.
So we saw about 17 days then.
Yeah.
2019, kind of the last normal.
Seems like a normal market.
Yeah, between 20 and 30 days on the market.
Hot. Okay.
Yeah.
And that seemed to be a pretty hot real estate market as far as purchases were concerned.
Yeah.
Rates were good. They were much lower than they were now, but they weren't the lows of. They were higher than 2016 and 2012, but they were probably better than 2018.
Yeah, absolutely. All right, well, I could spend all day talking about the monthly data, but I did want to go over some of the weekly stuff too. So new closed sales week over week, down 32.1%. Purchase contracts down 4.2%. New listings down 11.4%. There's a new number that I'm kind of looking at now. There's a ratio of pendings to listings. It's showing how things are going off the market quicker than they're coming on, right? Mm-hmm. So that ratio is up 8.1% and up over a year ago from 56.7%. So there's a tremendous amount of increase in the pendings. More homes are being sold than they are coming on the market. And showings down about 18% from a week ago and about 40.2% from a year ago. So anyway, that's the scoop. Oh, well, it's not the scoop. That's the rundown. But it was the scoop on,
that's the scoop on the rundown.
On the market, right?
Yeah, scoop on the market.
When we come back, we're going to get into the scoop where we talk about the diamond in the rough, home buying with renovation loans. And we'll be back in just a sec. Try it. We're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long & Foster and joined by the incredibly insouciant...
There's some alliteration.
I knew I could bring some in.
Michael Becker of Sierra Pacific Mortgage.
Hey, Michael. So we're going to jump into the scoop, and we're talking about this concept of buying a home that's a diamond in the rough. And home ownership, that's a dream most people have. A lot of people have, right? There's studies out there now. Mm-hmm. We were worried about it for a little while. Is home ownership still going to be the American dream? And then and the newest
studies. There's been people who've been disappointed with the process. We talked a little bit about that in the Unreal in previous shows.
Yep.
Yet, still a super high percentage of people think that home ownership is
the American dream. Right, absolutely.
I think it's 71% or 78%, super high.
Definitely
number.
A high number. Yeah, absolutely. Well, and so in this market, what if you don't have cash to pay? We talked about it a little bit in the intro, but what if you don't have cash to pay well over list for that updated home? Everybody loves it, so you're going to be competing against a lot of other people. What if you can't find anything? If you can compete on in that area that you want, where you want to be, what do you do? So
you might have to find that house that needs some work.
Yes,
and you have to you have to look at the house and the neighborhood it's in, and the type. We're going to go over in not great detail, just a little bit of detail, the different types of renovation loans and what's involved with them.
Yeah, no matter what we tell you here, there's still more detail behind it.
But it may be tough to buy a house that needs minor cosmetic repairs.
Yeah.
You may be going up against somebody who doesn't care, but they don't want a loan. They'll finance those cosmetic repairs out of their pocket.
Sure.
So that might be a tough house to get.
Yep.
If you find a house that's really lowly priced because it needs a lot of work, who are you going to go up against in that?
That's investors. And you can be a much more appealing buyer for a seller than an investor who has to make a margin
We're on the
what
same
they're
page.
reselling.
I was going to say you may be against them, but your offer might be greater because you do not need the profit.
You don't
margin.
need to make that profit.
You want to rehabilitate the home, and yes, there's going to be equity down the road because you financed the rehab.
Yep.
But you're not selling, so you don't need that profit margin. So you may be willing to offer a little bit more. So the point being, when you're looking at, if you're going to consider this, you have to know who your competition is with that home, and your agent, like Brad, will tell you. I was suggesting to you that somebody mentioned to me about a rehab loan about a townhome in Sparks, Lumpkin Farms.
Right.
And it looked like to me that it was just cosmetic, needs updated bathrooms and kitchens, things like that. It might be a tough one to win.
That's tougher to compete
Why? Let's start with there because...
Well, for a couple of reasons. I think because people are, in general, less informed about the renovation
No, I meant
loans.
why would it be hard to get your offer?
But here's why. Because even the listing agents don't know all the details about these renovation loans.
They hear it and they're going to think it's going to be a headache, and there's going to be multiple appraisals, and there's going to be this, and there's going to be that.
Too much.
I will say that it does take a little longer to close than a regular purchase loan.
Right, but eminently doable.
Right.
Absolutely doable. And I think that's one drawback that you'll have is that there are a lot of agents out there who don't necessarily understand all the details. But in a home that needs a lot more work, they're going to be a lot more willing to consider a loan like that. So what I thought, Michael, would make a lot of sense is you're the expert in this particular, in many ways, but
I'll
in this particular case, definitely.
Even, it's interesting. You can be an expert in something and then not recall the exact of it, but you can always look it up.
Yeah, sure, absolutely. But what I thought we'd do is I'd kind of fire away at some questions with you, and then you can chime in and let me know what you think. All right. So, first question for you. Mm-hmm. Let's talk about just the basic concept. What does the renovation loan allow you to do?
Quite a lot.
Yeah.
It depends on the type of renovation loan that you're seeking.
Yeah.
It could be cosmetic, or it could be as extensive with. Let me back up a little bit. The two big ones are the 203K.
Mm-hmm. That's an FHA product.
Thank you very much, Federal Housing Authority.
Yeah.
There's two 203K loans. There's a limited and a standard.
Yes.
Limited is more cosmetic and less in scope.
Yeah.
And then there's also, Fannie Mae has a home style renovation loan, which allows beyond soundness and safety and structural repairs, but it may allow some luxury repairs.
Yeah. Yeah. Updates, improvements.
Remember, you're going to be subject to loan limits on both of these. Mm-hmm. In the Baltimore area, a lot of people forget that the FHA limit did not increase as much as the conforming limit. It's $632,000.
Right. Conforming
limit is $726,000. There's some change in there, but just know that. So, rehab loans allow you to do quite a lot.
Yeah.
If you were doing a 203K standard, you could quite literally tear a home down to its foundation and rebuild the house.
Yeah, that's
from there.
That's pretty dramatic.
That's pretty extensive.
That's right? About as extensive as it gets.
But what you can't do with a 203K loan is build a swimming pool.
Right.
But you can with a home style renovation loan.
Right. So the difference in the types makes a big difference in what you're allowed to do. Right?
Well, and then it's also who's qualifying for it.
Yeah.
FHA loans, historically speaking, allows higher debt ratios, smaller down payments, and tends to be more liberal when it comes to credit. Don't need perfect credit to qualify. Fannie Mae is a conventional loan.
Right.
You're going to need much higher credit scores. Put 5% down. Unless you qualify for a home style renovation / home ready loan, because your income limits, you can put 3% down. But most of them are 5% down. Is
there any difference in credit score requirements for the renovation loan other than the fact that you have to qualify for the total amount? Meaning the after repair value?
Well, if the home style renovation loan is going to have the same loan level price adjustments that any conventional loan will have.
Okay.
And FHA doesn't. I mean, some lenders have their individual pricing adjustments, but generally speaking, it's a pretty similar rate no matter what your credit score is.
Okay.
You do need, conceivably you could go down to a 500 credit score with an FHA loan, but that's regular FHA requires 10% down, so would a 203K loan, but I don't think there's any lenders doing 203K loans with 500 credit scores. Generally speaking, a 620 is what you're going to need.
Yeah.
580, a lot of lenders will do a regular FHA loan, but they're not going to do a 203K.
Well, there's some more risk.
You could probably find some, but I guess I got to look around them. But
yeah, by and large.
But
all right.
By and large.
Yeah. So they take a little longer to close, right?
They do. It depends on the type of loan there is, but there's more people involved. First of all, you have to have a contractor who has to write up a work order or submit a bid. If it's home style renovation or it's a 203K standard, a 203K standard will need a HUD consultant to review those things. That construction order or the repairs to be done is going to be given to an appraiser. Not every appraiser can do this. They're going to do a subject to appraisal. What's the house worth after all these repairs on? Because that's what the loan's going to be based upon.
Yeah, different skill set.
Yes. Yeah. So, and those things take a little bit longer. There's a lot of work that needs to be done. So you have to buy the house or be interested in a house. Find out that the listing agent is going to be willing and the seller is going to be willing to accept
the renovation loan.
Then you have to have a contractor on hand that's going to be able to quickly give you these estimates so the appraisal can be done.
Right.
So they do tend to take a little bit longer. It's not, and then I have to get paperwork completed by the contractor as well.
Yeah. Though if it's if it's a home that needs as much work as we're talking about here,
Right.
very often that home isn't going to go in a day. Typically, you'll have a little bit more time.
Do an exercise, listeners. Go to Zillow and go around there and click on some properties and see. Try and find some ones. I wonder if they have this way to search it to see time on the market. I think they may, in the more down arrow. And some of those homes that have been, there are homes that have been on the market 100, 150 days.
Sure.
They're just sitting there.
Yep.
And they're waiting for somebody like that.
So, what other things regarding time regarding time or time limits should buyers know, right? Like, I think, isn't there repairs have to be completed
Great
within
question,
a certain
man.
time?
I wasn't sure if that's what I was thinking initially when you asked the question.
Yeah.
So, first of all, repairs must commence within 30 days of closing. So, if the seller of the home...
And that's a good point. We should just make sure everybody understood what you just said. The repairs happen after you settle on the home. It's within closing, 30 days within closing.
You don't close, and then they don't give you a chunk of change to do these repairs. Basically, you close on the loan, and there's an escrow account.
Right.
I might be getting ahead of myself.
That's okay. That's okay.
Right. I'll wait for you to ask me that question. But yes, repairs are done after you purchase the home.
Right. And so it has to start within 30 days.
So what if you had a rent back for a month?
It's a good question.
It's probably not going to be able to. So if you have a seller who wants to rent back from you for a while, you either have to delay closing. It can't happen. They must start within 30 days.
Right. So. Although typically, if the house is in bad enough shape, hopefully nobody's living in it now, and you have less of an issue there.
Yeah, and if it's in bad enough shape and you can't live in it, you can roll in with an F203K. You can roll in 6 months of the mortgage payment.
Yeah. That's right. Good.
But repairs must start within 30 days, and this with the 203K must be finished within 6 months. I believe the home style renovation gives you a little bit more time with that.
Good. All right. So, any other expenses? I mean, we talked about maybe some of the other people that might need to be involved.
Well, there's going to be there's cost per draw.
Yeah.
There's going to be an escrow account set up to pay for those repairs. We don't give the contractor all the money up front.
Right.
And it depends on the type of...
Which is smart. Take that lesson, people. When you you do renovations, don't give contractors all the money up front.
Correct. So there's an escrow account, so there's money per draws.
Yep.
There's multiple appraisal. The appraiser is going to have to revisit it and make sure that a certain stage of completedness or a stage of the rehab has been completed.
Right.
To prepare
to sign
the draw.
Off for the draw.
And for standard 203Ks, contractor has to do a little bit of work before they get any money. They must know that up front.
Yeah.
And there's, that's something that needs to be relayed to a contractor. But once they complete it, they'll get a draw. And then the next section, so the appraiser has to go out there multiple times. There's times for that. A standard 203K with repairs they have to be reviewed by an FHA-approved HUD consultant. That's a great balance and check against you getting overcharged by a contractor. They're going to review the costs and what you're being charged in the repairs.
It's great
and make sure it's in line.
Yeah, it's great to have somebody with that industry expertise to be able to say, yeah, this is a fair price, this is not. Yeah, great. Okay, good. So we talked about, maybe some of the differences between the limited and the standard. Minor and major renovations.
Well, there's dollar amounts. So when it comes to a limited 203K, it's more for cosmetic repairs, and you're going to be capped at $35,000. Now, truth be told, you're probably better thinking about $30,000 because when you're doing a 203K, they tend to put 10 to 15% overages.
And an overage, right? Yeah.
In there because sometimes there are cost overrides.
Happens all
and
the
if
time.
you only budgeted for 35 and it comes in 38 and there's no money, it's not going to happen.
Right.
If you budget for that overage and you don't use it, it basically is just that money gets put back as a principal. You get it back not in cash. It just reduces the principal amount
of the loan.
Right. Of your loan moving forward.
Yeah.
So that's and with a full 203K, although it's crazy, it's a minimum of $5,000. I wouldn't do a rehab loan for $5,000. The extra cost.
Right. There's a lot of
rates are also higher for these because they tend to be a little risky for the lenders. But most people who do 203Ks or home style renovation loans with higher rates, they do it to finance. They don't have the money to finance the rehab, and usually at some point after closing, depending upon what stage of the interest rate cycle you are. If rates are at their highs, you might ride it out for a while. But if they come down, you're probably going to refi. Nobody keeps that original loan for very long.
Right.
Might be 6 months, might be 2 years, but you're not going to keep it forever.
Yeah. Okay, good. So we talked about this a little in the beginning, some of the types of renovations that you can make, right? So, and there are things that make sense, things that don't make sense. There are actual limits on things that you can do, can't do. Like we talked in the break about the difference between the home style renovation and an FHA 203K with regard to things like outside the house, landscaping.
Landscaping can be done with the home style renovation loan.
Yeah.
You can do landscaping with the 203K, but it's more about grading and the safety and soundness.
Right, which is similar to anything else with a government loan, right? When you do an appraisal with a government loan, they're looking for health and safety issues. Same thing here. We want to keep water outside of the house.
Right.
Yeah. So that's a good point. What about things like those luxury items, right? Like if you want to put, can I put granite or quartz countertops in there? Can I have stainless appliances? I want to put a new kitchen in. Can I do that with these kinds of loans?
So I don't know that FHA would deem granite countertops a luxury item. It seems to be pretty standard in many homes these days.
Sure.
But things like a swimming pool, an outdoor kitchen, right? Like a lot of people, if you have a swimming pool, you got to have the grill and the outdoor kitchen out there with a big fireplace, heat,
right?
Fire pit and things like that. Those are kind of luxury items. You're not going to be able to do that. You might have to
with the FHA 2 or 3.
And you must remember,
but you could do that with a home style.
These repairs have to make sense in that the subject to value based on those repairs is what's going to be calculated. And there, as we all know, some rehab projects give you a higher percentage return on dollar than others. Mm-hmm. The luxury items tend to have less of a lower percentage.
Right.
They might be nice and entice certain buyers to buy your house, but it may not add
the resale value
to the resale value as a percentage of the cost.
Right.
So you're going to be capped on that unless you have deep pockets and want to,
Well, and it depends on the price point of the house too, right?
Agreed.
A $1 million home is going to have a different look on that than a $500,000 home.
$1 million home's probably not going to be done under rehab.
Probably not.
Most people who can afford that price point probably
can fund their own.
Yeah. These are what we're trying to talk. But you're right. You can put a swimming pool in for home style renovation. The cool thing about a home style renovation too that we haven't said is it allows for second homes and investment properties. Larger down payments are required for those, and the same loan level price adjustments apply. Yeah. But you can, if you had a second home or an investment property that you really wanted to rehab, you could conceivably do it that way. Purchase it as a rehab. 203Ks are strictly, and that's what we're talking about, primary residences. I would say most people, when rehab loans are talked about, what do they talk about mostly? It's a 203K.
Usually, yeah.
And the people that we're talking to probably are doing 2 or 3K. So what you can do with the full 2 or 3K, you could literally, like I said, tear the house down to the foundation and rebuild it all new. You can expand. You can upgrade for energy efficiency.
Right? Yeah, efficiency.
Expand. You can expand the house for living space. You can put a whole new addition on it with a 2 or 3K. You could update kitchen, bathroom. That's something that's pretty common.
Some of the other things that are kind of interesting.
How about a roof?
Absolutely. Yeah. Or mold remediation.
You can do that.
Or lead paint remediation.
What if you
or asbestos remediation?
What if a house was in a perfect neighborhood nearby public transportation for a disabled person, but it was not set up for that disabled person?
Oh, yeah. Accessibility item. Yeah, absolutely.
It's a big one for 203Ks that a lot of people use. That's one of the best purposes.
Yeah, absolutely. That's a great point. Yeah,
people don't think about it. It costs money to update a house to make it accessible for somebody who's disabled.
That's a great point.
So there's a lot. You can do almost anything. Just don't. You probably want to if you want to do any of the luxury items, you should probably look at it. Home style renovation.
So you want to put your enophile wine cellar in the house. You're looking at a home style.
I'd probably, if I have the money to fund a wine cellar, the wine that goes in the cellar.
Right. You probably have the money.
I could probably fix that up. But yes, there's certain things like my future home or my retired home, that would be one. That would be on a wish list, but it's not a must-have. I'm getting off topic here. I hope you don't mind.
That's right.
But I do like cooking at home.
Oh, yeah.
And the next home I buy, I will not buy another home that does not have a hood above the range. Because I like to cook, and it can get smoky when you're cooking. And if you have a nice exhaust hood, because the one that's on your microwave that's above most people,
all it does is recycles the air.
It just pushes it out. It doesn't do anything.
Yeah.
Anyway,
Good
I'm sorry.
point. No, that's a good point. All right. So
I would get a 203K to put that range hood.
there you go.
I don't think that would be a luxury item.
Because
it's an updated case. A lot of them have
it's
it.
part of it. Yep, absolutely. Is there a limit on how much you can borrow?
Well, you're going to be topped at the
loan
limits for the local area.
Yeah.
Right. So you got to factor in all the closing costs associated with it, the loan limit that you can borrow up to, and the amount of the repairs.
Yeah.
But you could conceivably buy like let's say a house that has a great foundation but dilapidated. You could buy a house for $150,000 and make it, as long as it would appraise, the subject to value was enough to cover the costs or put them into the loan.
Yep.
You could tear it down to its foundation and build a $400,000 or $500,000 house conceivably.
Yeah.
I'm sure those have been done. There's been people the repairs have been greater than the purchase price.
Yeah.
Those are few and far between, but it can happen.
Yeah. And it may seem obvious, but I don't want to assume that it's obvious. But with regard to how much you can afford, how much you can borrow, it also
you're
also
limited
has
based
to
on
do
that, right?
based on what you qualify for.
Correct, and that's another good point to delineate here. It's another reason we think a lot of first-time home buyers or people who are looking for that diamond in the rough would probably stick with the 203K. It's more lenient when it comes to credit and debt-to-income ratios.
Yeah, that's a good point. Okay, so let's just talk about how the process works, right? From finding a home to getting under contract to settlement to occupancy, and then how the renovation itself happens. And let's talk about that. So you find a home, and you have the conversation with the listing agent, and you say, "Hey, you're willing to take a renovation loan on this?" And they say yes, and then you start going down the garden path with your lender, and you start talking about how to get all this together. Pick it up from there. What do you do?
Well, they're going to have they've had conversations with contractors prior to looking for homes.
Yeah.
Interviewed them, because once they're under contract, or maybe even prior to being under contract, they need a work order write up by a construction company.
Yeah.
And that construction company is going to have to provide that work order to the appraiser.
And one other thing to keep in mind here, must be a licensed contractor. Can't have Uncle Billy, who's handy, do this work.
And unfortunately, sweat equity can't be done. You can't do even now. I would say this: if you're a licensed, it can't be you, but if you're a licensed electrician, and somebody else is the general contractor, you could essentially do that work. But that's few and far between. Generally, they don't want you doing the work on your own home.
Yeah.
Even though it could save you a couple bucks. So a licensed contractor will have to be the GC for that. Write up the work order, submit it to the lender along with other paperwork. They're going to want to see your suppliers. They're going to ask for some specific data from the contractor to approve them, because they're not all approved. Now, if they've done a lot of 2 or 3Ks and work with a specific lender, there is a chance that paperwork has already been done, but they have to contribute. These are things that can delay it, by the way.
Sure.
Because people get angry or put off by asking for certain things. So the work order's put up. We get that. Give that to the appraiser. The appraiser's scheduled. The appraiser's going to put together a subject to appraisal. If the value comes in where we need it to be, and it'll appraise for enough to finance the repairs, the loan goes through just regular underwriting just like that.
Yeah.
I mean, that's the big step, getting all that stuff in the beginning. The setup of a 2 or 3K is very, very important. If you get all that stuff pretty quickly, it tends to flow. The rest of it's just credit and income underwriting.
Sure.
As long as we have the work order, if it's going to be a full one, we do have to get the HUD consultant in there to review the work of the work order from the contractor, get the appraisal done. That goes in. Meanwhile, the credit and income has been underwritten by the underwriter. At that point, it's all been approved, and it closes.
Have you seen a 30-day close happen with one of these?
I don't think so.
Yeah,
no,
and
you're talking about parts.
You're talking about a 45 to 60-day close, probably.
I would think so. That would be smarter. But just
so don't
there's so many more
plan
people,
on that 30-day. Yeah,
you're not going to be able to,
right.
unless
unless
somehow you've been eyeing this property for so long, and the seller let the contractor go in and write up the work order before you even submitted an offer or anything like that, and did all that stuff.
Right.
And you had everything in line. That might be the only way.
Yeah. Yeah.
But I don't think that's possible.
Right. So you settle, you get the keys,
Right.
you start the
You
work.
can move in. It depends on the type of it.
Right.
Some people live in their homes. Other people's the work. If you're tearing the house down to the foundation, you're obviously not going to live
Not going to live in the home. Yep.
And I mentioned you can, if it's that great that the house is deemed unlivable while repairs are being done or rehab's being done, you can roll in up to 6 months of the mortgage payment into the loan amount.
Yeah.
And
Is there a possibility for living off site and having some of those costs?
That's a great question. I have to
Factored
look
into
it up
it?
because I've seen
Yeah.
people who live in a trailer
Yeah.
on the property, right?
Mhm.
Like put a trailer in there and just rough it while that's getting done.
Interesting.
So,
Okay. All
I
right.
don't know. That's a great question.
Yeah. Okay. Great. So then,
Maybe not. I would say probably not because think about it. They probably have to pay their rent if they were living somewhere else because their mortgage payment is being covered.
Yeah.
I guess the idea of rolling in the mortgage payment while there's being a rehab is so that you don't have two housing payments.
Right. Okay. So draw 1 happens, draw 2 happens, draw 3 happens. Is there anything that happens at the very end that needs to be done that just ties it up in a nice big bow?
Yeah, it's got. I mean, the appraiser has to confirm that everything's been done to order, and once it's all been done, and all escrow funds, you're not get the contractor's not getting their final check until everything's been completed, the final draw. But once final draw is completed and it's deemed closed, it moves over and it just starts being serviced. If there's any money left over because of the cost overrides that we talked about in the beginning,
Then you get your credit toward your loan balance.
it is a principal reduction, right? Your mortgage payment's not going to change; it's going to be the same, but it does reduce the principal amount, which means you have more equity in the home.
Yeah.
And it may make it easier for you to refinance.
Yeah.
Down the road.
Okay. If you have more questions, Michael's available. You can reach out to him, get all the information that you want. Great product, though, something to consider, and that's why we wanted to bring this to your attention today, because it is a tough competitive
I don't think there's a
market.
lot being done, but I think it's going to start coming back. And
Yeah.
it's something to consider, especially if you've been priced. The reason for doing this show and talking about it,
People get priced out.
people are having a hard time getting the house they want.
Yeah.
It might be. It just occurred to me that it may be a way to get the home that they want.
Very nice. All right. So, Michael, when we come back, we're rolling right into the Unreal and the Spotlight. So we'll be back in just a second.
Trap.
And we're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long & Foster, joined by this surprisingly sanguine.
No, I know what sanguine is.
Yeah. And why? Optimistic or positive in the face of bad situation. What a great attribute for a mortgage lender to have.
That's at least the face I show.
Right.
I have these internal demons that are the opposite of sanguine.
Don't we all?
Yes.
All right. Well, Michael,
Yes, sir.
we're rolling into the
Wait a minute. I
Unreal.
got to ask you, are you pulling
What?
these? Are you looking up in a thesaurus before we record, or are you just pulling these out of the...
I'm trying to
And
find
can
things that are...
do I need to start preparing for equally
You can do...
sesquipedalian adjectives?
You can
as
do
yours?
whatever you'd like. I try to find... I think about, words that I think describe you.
Well, you're very kind.
Aptly, not,
And it's all been in a positive light, so
Right.
I shouldn't say anything
Right.
about
Well, I may
it.
pick negative words and then say the never nefarious or something like that.
Never nefarious. That's
Right.
good.
Yeah, but whatever. All right. Well, Michael, we're rolling into the Unreal.
The Unreal.
You sent me a really good article.
Well, it's
and-
always a struggle because with the Unreal, what we're trying to do is something that's weird or odd or something jumps out at us that doesn't sound right,
Right.
or something that, even with our limited powers, we can fix. And if we can't fix it, we can at least advise
Right.
anybody who's listening
Yeah.
potentially a way to fix it.
Right.
So
See?
it was a headline that I couldn't believe it.
Yeah. In the
First of
basis
all-
point.
6 figures in income,
Yeah.
100,000 or more.
Right.
Always seemed to be something that was a big deal.
That was the goal, right? Get
They used
to that.
to have jobs. I can remember a commercial for a recruiter that said for 6-figure jobs and up, right? It was only
right.
recruiting for those. Mm-hmm. Yes. Now, It's still a nice threshold to cross.
Lost a little bit of its cachet.
It's kind of like a millionaire, big deal.
Yeah.
Right. Now you got to be a billionaire to be a big deal.
Right. Yeah.
The headline jumped out at me.
Yeah.
Because we hear about people living paycheck to paycheck, and a certain percentage, I can't remember the percentage, but it's over half of people in the United States which struggle with a $400 repair emergency bill. 15 million six-figure income earners live paycheck to paycheck.
Wow.
So they did the numbers. I think it's 35.8% of all people. Household. This is household income.
Yeah.
Make over $100,000, 35.8. It's slightly. I tried to find some more accurate number for Maryland. It does appear to be a little bit higher, like about 40%. Maryland being a higher income state.
I mean, you think about it. That used to be, you were in the 1% if you made over 100,000.
You asked me that. I said, I don't think
not
so.
anymore. Not anymore.
Anymore.
Yeah.
But unfortunately, 32% of those making over 100,000 households making over 100,000.
Yeah.
Are struggling paycheck to paycheck.
Yeah.
Well, I guess it depends on that. What is the household? So if a household is one person, you're making $100,000, and you're living paycheck to paycheck, you should look into your spending.
Right.
If you're a six people and a couple with only one spouse working and 4 kids,
right,
I can see living paycheck to paycheck for $100,000 as much as it costs.
Sure, absolutely.
To raise a kid.
Kids are not cheap.
So the concern about that headline is why? It seems like if somebody makes $100,000 a year, they should be able to buy a home. And we've thrown out stats that say a lot of people see the value in owning a home. Mm-hmm. We want to stress to people, if you're somebody that, look at your situation. If you're making 6 figures and you're living paycheck to paycheck, is it the cost of living or is it you? It might be a combination of the two.
Right.
And
things have definitely become more expensive. But and there's more. My wife and I talk about this all the time. Used to be, when our parents were in their prime earning era, they didn't have cell phones.
Well, they didn't have cable. Was a big deal.
Services.
TV was free.
Yeah, water was free. Bottled water. Lewis Black does this great shtick on bottled water.
He's
about
right, 100%.
Right. What?
My kids don't think that. Every morning I drink water from our sink.
Yeah.
Or if you're from Baltimore, the zinc.
The zinc, yeah. That's water, too.
It's water.
Water from the zinc.
Water from the zinc. They look at me like I'm crazy because they've always gotten it from the refrigerator that's going through a filter, like something's wrong with our water.
Right.
Or it's from a bottle.
Yeah. And
I said, how long do you know? Do you have any idea where the source of that water is?
Right.
And how about it's sitting in plastic for how long?
Mm-hmm.
And did any of the chemicals from that plastic leach into that water? Nobody ever thinks about that.
Right. That's a great point. Right. Great point. Yeah.
So, but anyway, we'll get back to the topic at hand. 6-figure income, 32% living paycheck to paycheck. If you're making 6 figures, you should be able to own a home.
Right.
Look at your spending.
Yeah.
Try not. One of the biggest things people tend to overspend on, especially these days. I think Dave Ramsey had talked about it. It is somewhere between $600 and $700 a month, the median car payment nowadays.
Yeah.
It's crazy to me.
Yeah.
It's okay. I didn't buy my first new car, I think, till I was like 36 or 38.
Right.
Dave, look at your spending.
Right.
Used cars are okay.
Yeah.
Cars these days last for 200,000 miles. Buying a car with 80 to 100,000 miles when you're younger is okay.
Yeah.
Millionaire Next Door, this book I always remember, I quote it several times.
Yep.
Average millionaires, the age of their car is somewhere between 11 and 12 years.
Mm-hmm.
There's lots of activities you can do, you spend money on. I don't want you to not have any fun.
Right.
It's nice to go out with friends on occasion. But be wary, budget for it, and stay within your budgets.
Right. But you don't have to go out to lunch every day.
That's the thing. Limit brown bag it occasionally. Forego that Dunkin' Donuts or Starbucks coffee that costs $5. Make it at home.
Right.
You can do it. I've shown my kids.
Yeah.
How they can
coffee
make it
machines actually do produce coffee.
But anyway, you should be able to afford a home if you make $100,000. Look at your spending, set up a budget, and live by that budget. If you look at it, $100,000 a year, I'm trying to do this in my head. How much is that per month? It is $833.
Yeah.
Generally speaking, you could probably qualify for if you wanted to have a very affordable house, you could qualify for a $2,500 a month mortgage payment. That's keeping you at 30%.
Sure.
If you keep your debt to a minimum, you could afford you could go, this article says go up to 43%. Let's keep it at 40, okay?
Mm-hmm.
So 8,333 times 0.4. You could afford a $3,300 house. The median in this article, it said median value home was $363 with a small down payment. I think it was a 3% down payment. The mortgage would be at $2,881. That seems to be probably pretty close.
Yeah.
I wouldn't be surprised if it's around there, $2,800 or so, or $2,800. So you would qualify for that if you limit your spending and your budget.
Yeah,
it's smart.
So the point is, put yourself on a budget, spend responsibly, save some money.
I'm shocked at 15 million people who make six figures. 15 million households.
Yeah.
Live paycheck to paycheck. I can understand somebody who makes $40,000, $50,000 living paycheck to paycheck. It's a very expensive world we live in these days, but it seems surprising that there's that many people. And it's like, to your point, your wife's point, there's so many more things you can spend money on. It's easy to forget about it. Your cell phone bill, how easy is it to get it over $100 and some a month? There's ways to cut that down, right?
Mm-hmm. Yep, absolutely.
PG&E bill doesn't have to be 74 degrees in your house in the wintertime. Nor should it be 68 degrees in the summer.
Yeah, right.
Think about things like that.
Yeah. So there are things that you can do, but take positive steps to improve your financial situation.
It's unreal to me, to draw it all back.
Thank you.
That 15 million people who make six figures are living paycheck to paycheck. It doesn't have to be that way. Budget. Great message.
All right, Michael. Rolling into the spotlight.
I love
another Merit institution. They've been around forever. Yeah, it's right up the street on York Road.
How long has it? Do you know how long it's been around?
They've been family owned and operated since 1972.
Yeah, I was going to say I went to Cockeysville Middle School, and I went there in it was junior high school then. I guess they call it middle school.
Right.
Yeah.
Yeah.
And I started there in 70, and Corner Stable was around in 77, so I figured it'd been around since the 70s.
Yeah, I just thought I'd feature. We talked about Tio Pepe in episode 12. Just bring back another.
They got the best ribs.
Look, oh my gosh, the best. Absolutely the best. Don't go there planning to save on calories, but
or expect to eat haute cuisine.
Yeah, right.
H-A-U-T-E.
Right.
I pronounced it correctly.
Yes, you did. Thank you.
Yeah,
but that's the point. Yeah, it's good family, down home cooking, right?
So the best meal for me is a crab cake and a half rack of ribs.
And if that's not your interest, then they've got burgers, they got fish, they got the hot turkey sandwich, salads, things like. But who would go there for a salad? I don't know if anybody would go there for a salad, but
maybe a side salad.
Yeah, but it's not a stuffy, buttoned-up place, right? Really friendly, local, comfortable place.
I always see families eating there,
right? And super, super good food. One item of note now, this kind of affects me, but they don't have much in the way of gluten-free options. Their barbecue sauce has some gluten in it. It's a little bit of a bummer for me. Yeah, I might try to tough it out anyway because it's
I had no idea.
That good. Anyway, so they're open 11 a.m. to 9 p.m. Sunday through Thursday, 11 a.m. to 10 p.m. Fridays and Saturdays. Mm-hmm. They are at 9942 York Road in Cockeysville, and they are on Facebook. They're not on Instagram. They're on Facebook. You can search for the Corner Stable Cockeysville.
Okay.
Or you can catch them on the web, cornerstable.com, or give them a call.
I mean, you're talking about the Cockeysville. They have a...
They do. In King's Contrivance, they have a sister. Yeah, in Columbia.
I've often met my kids who are college halfway. That's a halfway point if they're in College Park for us to meet them for a dinner.
Yeah. Great. And you can also call them 410-666-8722. That's the Cockeysville location. I don't have the King's Contrivance Columbia location.
But if they called Cockeysville, Cockeysville
probably get that. Yeah. Or what if there was a place maybe where you could go online to just try to find information like that? That would be really cool if that existed, right?
Make life so much easier.
Wow. What if only there were? Yeah, but anyway.
How do kids do homework these days?
GTS, dude.
Well, now they do. Yeah, before it was Ask Siri, but now you're right, Chad.
And for those of you who don't know what GTS means, it's Google that stuff. Anyway, all right. Well, listen, if you haven't checked out Corner Stable,
Do it.
do it. They're a great location. All right,
They have
so
better
Michael.
music that you're hearing than you're hearing in the background too.
Yes,
Just
yes. Anyway, Michael,
Yes,
another
sir.
good episode. Thank you for all the great information on the renovation loans. Next episode, we're going to continue along the same lines of Diamond in the Rough. We're going to go with Lemonade from Lemons, renovating your home before selling.
Ooh,
yeah, so some good information on that. So tune in next week. You can check us out on the web, www.berealpod.com. Listen on the site, submit comments, give us any feedback, what you want to hear us talk about, how you think we're doing. Love to get some feedback. Also available on any of the major podcast platforms. So, Michael, somebody needs to reach you to talk about the mortgage world.
Or if they have questions about the rent.
Or the
barely
renovation
scratched
loans.
The surface.
You
There's
did.
so many more questions.
Lots to go
I feel like
into.
I left a lot out, but we didn't want to get into too much detail.
Yeah, so how do they reach you?
Give me a call or text me. A lot of people like to text. This is my cell phone number, 443-310-0012. Or they can reach me via email at michael.becker@sbmc.com. That's michael.becker@spmc.com.
Excellent, Michael. And if you need to reach me, that's 410-375-7550. Or you can reach me via email at brad@homesbyvesta.com. So, Michael, again, thanks for the great episode. Folks, thanks for listening.
Thank you for listening, everybody.
We do it for you, so appreciate you tuning in. And we'll talk to you next week in the next episode of Be Real,
The Maryland Real Estate Podcast.
Take care, folks.
Trap.